Good afternoon, everyone. So we have a number of presenters with us today. I'll give a quick overview of the direction we're likely to flow, and then Ted Hobson, who's with me, will jump in and give us an introduction and the rules of the road and procedure for the webinar. We're going to start with just an overview. I'm going to give you some context and structure of the CARES Act today, and then we're going to focus on two major loan programs that are in the CARES Act, the EIDL, and that's the Economic Injury Disaster Loans, and the Paycheck Protection Act.
Why don't I introduce people? This is Ted Hobson. Scott McGee will be co-moderating with me. We are very lucky to have some very capable people with us today. Cassandra LaRae-Perez, whom I've known for quite a number of years, has been focusing on preparing and helping small businesses in Vermont, and gave a presentation for her clients last. Somebody's going to be a little noisy here. Presentation of that designed for small businesses. I'm going to squeak my dog toy every time for the next slide. Cassandra is an experienced litigator and is now focusing on helping Vermont small businesses. I'll squeak my dog toy for the next slide. Okay. We have also Daniel Emanuele of the Mascoma Bank, who has been processing this emergency help in real time, and is a tremendous asset and can tell us what the progress is and what the pitfalls are of this process. And we have, next slide, John McSoley, an accountant who's very capable, has been helping lawyers. That firm has been helping lawyers I know for many years. And he is available to help, and of course your accountant can also help out. And he will have some help for small businesses and some advice as we go along. The next slide, please. Just this disclaimer, this is not legal advice. Don't rely on it. These are personal observations of the participants. I'm currently a state employee, and I hope to be able to say that next week. So ask questions in the chat box, and we'll try to get answers. But we have a lot of resources in the PowerPoint. There is a lot going on right now. There are a lot of live town halls and webinars as the week progresses, and we'll give you links to those as to any questions you may have. Please type your questions in the chat box. Scott and I will interrupt and try to get those questions to people and get those answered for you. And please, everybody, don't use speakerphones. Use just who the presenters just hold the phone up to your ear. Thank you. Okay, next slide, and you can begin, Cassandra.
Okay. So I'm going to blow through this because we have a lot of material today, but I just wanted to give you a little bit of context of the environment in which the legislation is arising. It's been a very short period, so if you're feeling a bit of whiplash, it's not surprising. We had our first confirmed case in the U.S. at the end of January, and from January to March 13th, we went from the epidemic being abroad to the pandemic being here, President Trump declaring a national emergency, and Governor Scott declaring a state of emergency on the same day. Within a matter of days, we had schools closed, we had prohibitions of mass gatherings and closings of restaurants and bars, closure of close contact businesses by March 21st. Same day, all non-essential businesses and nonprofits had to work from home. And then on the 25th, we have a Vermont stay-at-home, a Vermont stay safe order that right now is effective until April 15th. But we heard from Governor Scott yesterday during a press conference that deadline will be extended. We don't know until what date yet. He's expecting to announce that on Wednesday or Friday. These changes, of course, put a lot of economic pressure on all of our Vermont businesses, including the law firms. And so the relief that we might be able to access to navigate these troubled waters are the things that we're going to be discussing today.
Okay, next slide. So I just want to set up the situation here. The Wall Street Journal estimated earlier this week that 27% of the economy has been closed down. The virus is spreading. No one thinks that we've got this under control. It's going to continue to spread. I was lucky to watch a bit of a state data presentation yesterday. The state is doing an amazing job tracking how many gloves hospital has, how many masks, all of this stuff in real time from every hospital. We have some very dedicated employees, and we should all be grateful for the essential workers right now. Next slide. And so the big thing here is the slope. And you can see the U.S. has actually done the worst. This is a chart from beginning day zero and to the number of cases. We have a lower population than China, but our slope is worse than any of the other countries involved. So this is an urgent matter, and the key thing here is to reduce that slope. Next slide. Art Wolf is famed Vermont economist. The state last week received 14,784 claims for unemployment. This is the greatest number in history. It's an all-time record. And the Department of Labor is doing an amazing job in processing claims. And we'll go through a bit later what the status is of how to apply for unemployment and who's qualified. Next slide, please. And this is a plot I got yesterday from UVM Healthcare about social distancing. And you could also, that big orange lump is what we're trying to avoid, but you could also view that orange lump as commerce and in-person commerce that we're trying to basically lop off that lump. And that means small businesses in Vermont, the person-to-person situations that we're all familiar with and we love. Next slide.
So in the wake of these events, we've seen a number of legislative pieces coming out from not just Congress, but also Vermont. This is not comprehensive, but the key ones that have led up to the CARES Act, which is what we're here to discuss today, is we first had on March 6th, the COVID-19 outbreak was declared a declarable disaster under the Small Business Act. And that enabled access to the economic injury disaster loans at that point. That was later expanded in the CARES Act, but that was the first access that was made to the EIDL for the purposes of COVID-19 disaster relief. That was followed on March 19th by the Family's First Coronavirus Bill that dramatically expanded the FMLA, giving job-protected leave for COVID-19 related reasons. And it also provided for an emergency sick leave package that provided up to 80 hours of paid sick leave for employees that were unable to work for various COVID-19. We'll talk about that a little bit more later. My focus is actually on the CARES Act and the loan packages. I'm not as steeped in information about unemployment insurance or sick leave or other employer-related or HR-related matters. But okay, so back to where we were. We had the Family's Coronavirus Bill. We also had on March 26th, Vermont passed H681 and H742. Really, it's 742 that we want to be looking at. 681 initially had some of those provisions, but it just became more of a procedures for safe conduct of public meetings and elections bill, and everything got moved over to the 742 that broadens the availability of unemployment benefits for people who are unable to work due to reasons related to COVID-19. Okay. To exempt certain benefits from the, there is also relief in 742 to exempt certain benefits from employers' experience ratings. We'll get into this later. And then on the 27th, we have the CARES Act. So just an overview, just so that you know the context in which these loan programs exist. This is the Coronavirus Aid, Relief, and Economic Securities Act, the CARES Act. The purpose of this act, which is an important matter for interpreting it, is the purpose is to keep workers paid and employed, to enhance the healthcare system and economic stabilization. $2.2, I believe, trillion were allocated to this act. This is for Ted.
And this is the overall allocation in the CARES Act. You can see there's $377 billion for small business, and there's some indication the Fed is going to relieve banks by buying these loans. Unemployment insurance is also $260 billion. We'll be getting into that. That's also actually relief for small businesses we'll get into. Go ahead, Cassandra.
Okay. So the Act is broken into two major sections of divisions, I believe, Division A and Division B. Division B is not relevant to our conversation today. Division A is broken into 5 titles. Of these titles, we're really only going to be discussing 2, Title I and Title II. At the very end, if we have time, I'll quickly run through what is contained in 3, 4, and 5, just so you have a sense of context. But if we run out of time, it's not that important. What's really important to you today is Title I and Title II. Title I is the Keeping Workers Paid and Employed Act. That's where the Paycheck Protection Program lives, the loan forgiveness that's connected to the PPP, and the Emergency EIDL grant expansion is also in Title I. Title II is the Assistance for American Workers, Families, and Businesses. This is where a lot of the individual relief lives. It's unemployment insurance provision expansion, 2020 recovery rebates, special rules for retirement funds, exclusion for employer payments of student loans, employee retention tax credit, and other tax relief. Those all live in Title II. For a lot of those provisions, we'll be talking with John McSoley and Dan Emanuele. They know these sections as well as financial advisors, but we'll get to that as well. I'm going to start with the loan programs. So the 2 major loan programs, the Paycheck Protection Program and the expansion of the SBA Disaster Loan Program. These 2 overlay and work together. I'm going to talk about the EIDL program first, even though in the Act it comes second, because it's easier to understand how it interacts with the Paycheck Protection Program if you already know how it works. The Paycheck Protection Program is focused on trying to keep people employed, or if there's a period of time during the economic shutdown that you have to let those employees go to survive, it's to encourage you to bring them back when the height of the crisis is over, and it's also intended to keep you floating while you do that. So the Emergency Economic Injury Disaster Loan, it's pre-existing. It was built actually for other types of crises, usually natural disasters. It was opened up in early March, as I discussed, and then when the CARES Act was passed, its eligibility and it was greatly expanded, and a lot of its requirements were greatly relaxed to enable more people to take advantage of the program. So people who would normally be ineligible or restricted from applying now have some access to it. So for the Emergency EIDL, there's already a system in place. For the PPP, there's not a system in place, and so some of the struggles and some of the stumbles are due to trying to get this program together and off the ground in a matter of days. The Emergency EIDL is funded with an additional $10 billion for the purposes of COVID-19. The funds come directly from the U.S. Treasury. For this one, you apply directly to the SBA online. For the PPP, you go to your lender. I'm just saying that now because that's a big difference between them. I will repeat a lot of these links in other slides, but you can always take a photograph of this, and the slides will be made available later. But this is where you go to access the online application for the EIDL. There's a maximum loan amount of $2 million. The maximum for unsecured loan is $25,000, and I believe the maximum amount you can get without a personal guarantee is $200,000. The interest rate is 3.75% for small businesses, 2.75% fixed for nonprofits. And while I say that, I also want to point out that these things keep changing. As you may know, the interest rate for the PPP was changed 3 times. Well, in the Act, it was up to 4%. It got changed again. A lot of these things are in flux. So I try to check everything before we started this presentation, because sometimes from one hour to the other, things are different. They could be different 5 minutes after I finish this presentation. So always be sure to double check everything you might see here, because it may not be valid in an hour. The EIDL allows up to a 30-year term, and there's an interest deferment that the lenders can give you for up to 4 years. You would have to request that. The really attractive part of the emergency EIDL is that applicants may request an emergency advance of up to $10,000. It must be needed to cover allowable operational expenses. The Act provides that the advance is to be dispersed within 3 days while your application is still pending. I understand there is some difficulty in getting that funding within that period of time. The other thing to note is the $10,000 is not a guaranteed $10,000. It's up to $10,000. Then from what I have heard from representatives of the SBA I'm sorry, I'm getting a little feedback. Representatives of the SBA is that may be keyed on the number of employees you have. I don't think that's provided for in the Act. It's not even, as far as I remember it, in the interim rules, but I believe that's being applied. So if you don't have a lot of employees, you may not get that full $10,000. But you may get a portion of it. If you do get that portion, if you do get that advance, the attractive part about this is that advance does not ever have to be paid back. That advance becomes a grant once you get it, as long as there's no fraud, for example. That $10,000 is a grant, but is not included when there's an overlay with the PPP because it's already been forgiven. We'll talk about that again, but I'm just giving you a little foreshadowing. So if you have applied already for the EIDL prior to March 30th, it doesn't say this on the rules, but you are encouraged to apply again. The SBA says that you won't lose your place in the queue by doing it. The reason you would do that is because prior to the CARES Act that was passed on March 27th, that $10,000 advance was not provided for in the EIDL before. So even though the EIDL was opened up for COVID-19 reasons, that $10,000 advance was not present. So you are encouraged to apply again if you still have a pending application for the EIDL. And you should not lose your place in the queue. I say that, but I say that based just on statements that I heard by a representative of the SBA. So double check that. Don't just rely on my statement with that respect. The only requirement that should be asked of you before the funds are dispersed is that there should be a verification that you are an eligible entity. The lender should be able to accept a self-certification from you under penalty of perjury that you are eligible. And you should not have to provide tax refunds in order to gain access to that grant. Who can apply? It's been greatly expanded to include businesses, cooperatives, ESOPs with 500 or fewer employees, nonprofits, and in this case, they don't necessarily have to be 501c3, although they do for the PPP. Small agricultural cooperatives, sole proprietors, independent contractors, and you don't have to have employees in order to access the emergency EIDL, which I know goes back to that grant. Should I get that grant if I don't have employees? There are a lot of moving parts. Tribal small businesses also should have access to the emergency EIDL, and any other entity that was already eligible remains eligible. So if you're not a 501c3, you can still apply for the emergency EIDL if you are a private nonprofit with an effective ruling letter from the IRS granting tax exemption under 501c, D, or E of the Internal Revenue Code of 1954, or if you can provide satisfactory evidence from the state that a non-revenue producing organization or entity is a nonprofit, one organized or doing business under state law. This comes from the ACCD's website at that link if you want to double check it, and I suggest that you do. So to gain access to the emergency EIDL, you must demonstrate that you've suffered a substantial economic injury due to COVID-19. The injury has to be the basis for the amount of the loan for which you are requesting and the amount for which you are entitled. Less any amount that might be covered by insurance or another source. You can't double dip. If you applied prior to March 30th, as I said, you're encouraged to apply again. The covered period for the emergency EIDL is January 31st, 2020, not the 1st, to December 31st, 2020. You can use the proceeds for ordinary operating expenses, including, but this is not a limited enumerated list, providing sick leave to employees, but not those that are covered by Family First, maintaining payroll during business disruptions, meeting supply chain costs, making rent or mortgage payments, repaying debts that can't be paid due to lost revenue because of the crisis, provided all these effects are due, all of these losses are due to the effects of COVID-19. A lot of the rules have been relaxed or waived that would normally apply. For example, personal guarantees are not required on the advances of loans of $200,000 or less. Businesses do not have to have been in operation for 1 year prior to the disaster. This is new, but you do have to have been in operation by February 15th, 2020. Oh, I'm sorry, excuse me, for the EIDL, you had to have been in business on January 31st, 2020, excuse me. You don't have to show that that you are unable to find credit elsewhere in order to get access to this loan. And lenders are protected. They can approve applicants based solely on credit scores, and I don't have to ask for tax returns. Everything can be submitted online through the application portal. So to find the SBA
there's a question about the
emergency.
Cassandra, there's a question here about maybe we could ask Daniel about the turnaround time for emergency EIDL. There's a statement I have a client who applied. Right, I have a client who applied 4/1/2020, today is 4/7, and no action is taken. Danielle?
I'm sorry to hear that. In theory, yes, if the emergency funds are requested, the SBA is supposed to turn that request around in 3 days' time for up to the $10,000. I'm not surprised. Excuse me. I'm not surprised at that. Similar cases across the state have taken longer than 2 days. Fortunately, we don't have any direct access to the SBA for the EIDL loans, and I know how difficult it is to try and contact a person at the SBA these days. I would suggest that you keep trying, and you know, I may need to reapply, but without knowing specifics, I wouldn't want to opine on that. But I'd say keep at it.
I have heard that applications that were made over the weekend received a response from the SBA saying that they anticipated calling the individual within a week's time. So whether or not one would expect the funding of the advance to occur before that phone call, under the Act, you would expect so, but in practice, that does not seem to be working out. So let's move to the Paycheck Protection Program. This works together with the EIDL. You can apply for both within certain restrictions. The PPP is funded by a $349 billion loan allocation. But bear in mind this, because the eligibility is so broad, this $349 billion is likely to run out relatively quickly, so time is of the essence. The program provides loans of up to $10 million, but we'll go through the calculation on how you decide what your maximum loan amount is. It is based on, it's calculated based on your payroll costs. Yes, this is a forgivable and forgivable loan. It's not necessarily a grant. If you apply for this loan, don't rely on the forgiveness because there are strings attached, but we will discuss those. For the amounts, if any, that are not forgiven, it's a 2-year loan at a 1% interest rate. You may have seen other maturity periods, you may have seen other interest rates because they did move and change, but this is where it is now, a 1% interest rate for over a 2-year period after payments are deferred for at least 6 months. No personal guarantee or collateral is required for this loan that is set in the Act. It is possible to have 100% of the loan forgiven, but there are a lot of criteria, which we will cover. Payments are deferred for 6 months. And there's a question I have on that. I believe you have to request that deferment, but lenders may be giving it as a matter of course. Dan, can you speak to that?
Yes, I can share with you that we have laid the funding on a couple of the requests that we've already approved to May 1. So we believe that there is some lender discretion at that, although the SBA is looking to clarify. We're looking for more clarification from the SBA on that. In theory, with the funds being available through June 30th, we assume that you will have until June 30th to close the loans themselves. That's how some lenders are operating. Not just Mascoma. We've heard anecdotally that other lenders in the state are doing that. So yes, the deferment I believe is possible.
Daniel, there's also a question about whether the funds are running out already. Do you know anything about that?
I wish I did. I saw that comment in the chat box. We have not been given any indication yet that funds are running out. I will tell you that as of the close of business yesterday, we had requests for $80 million over 622 applications. So if that's an indication as to what the other lenders are experiencing nationwide, we know it's first come, first serve. That's what we're telling our clients. If you're interested, we've got to get applications in rather than later.
Okay. And with respect to payments on the loan after the forgiveness amounts have been calculated out, for the remaining loan, are you automatically deferring payments, or is that something that the borrower has to request?
We believe that the borrower has to request that for the 6-month interim period. The interest is still accrued, of course, but that does have to be requested at the time of funding.
Okay. So the amounts borrowed under the SBA disaster loan, but the economic injury disaster loan that we discussed earlier, that can be refinanced under this loan, raising your maximum allowable loan amount. But the advance that you received, the $10,000 or whatever amount it was, cannot be refinanced under the loan because it's a grant. You don't owe that. And so neither is it added to the maximum loan amount, nor is it forgiven because it's already been forgiven. So it's already accounted for. So how do you calculate your maximum amount of the loan? Depends on the kind of business you are. If you've been in business for a period of time, then it's, or at least for all of last year, it's 2.5 times the average monthly payroll over a 12-month period prior to the date when the loan was made. That's what it says in the Act. In practice, I understand, and Dan, please correct me if I'm wrong, or John, I believe it's actually the 12-month period prior to the covered period, which starts February 15th. I think that's been how it's been calculated. Does that seem right to you two?
I have seen on, I think on an application that they wanted calendar year 2019 for the base. And I don't know
what. And is that allowable?
We have been relying on calendar year 2019 profit and loss statements, okay. Not tax returns. Okay.
One of the suggestions is Ted Hobson. One of the suggestions that I heard was that people submit their February 15th to February 15th payroll, their March 1st to March 1st payroll, and their calendar year payroll, so that the banks would have the option to look at whatever they want to look at.
Under the Act, it actually says 12 months prior to the loan, but it's so squishy that I imagine that you could choose one of those. So you take and we'll talk about what counts under monthly payroll on the next slide. So that's for businesses that are in existence now, but they also wanted to include brand new businesses. In fact, they wanted to prioritize those. And so if you're a new business, then it's 2.5 times the average monthly payroll costs. I should have had costs there, from January 1 of this year to February 29th of this year. And for seasonal businesses, you have a choice. Average monthly payroll, and this may not apply so much to this audience, but 2.5 times either that period of monthly payroll costs from that period, February 15th, 2019, last year, to April 10th last year, or March 1 to June 30th of last year. So it would depend on the type of business. The amount, if it goes over 10 million, it can't go over 10 million. That's the top loan that one can receive no matter what that calculation might be. So what are payroll costs? It's very broad. It's more than your salaries. It includes compensation to employees, which includes salaries and wages, commissions, cash, paid leave, again, as long as it's not covered under the Families First. Compensation paid to independent contractors. Now, I'm going to come back to that one. Severance payments, group health benefits, and that includes the insurance premiums you've paid for health insurance for your employees, retirement benefits that you pay, state and local payroll taxes, but not your federal taxes, and compensation paid to sole proprietors themselves. There is some disconnect in the Act and then the rules that came out later. It does clearly say compensation to independent contractors is allowable as a payroll cost. It led some of us to believe, does that also mean the fees that you paid to your lawyers, the fees that you paid to your accountants during the covered period to get to this point? And the SBA has clearly said absolutely not, because independent contractors can apply for themselves. Therefore, the payments that you have made as a business to independent contractors does not count. Apparently, the way it was intended under the Act was because independent contractors can apply for themselves, then compensation they paid to themselves also counts. If there's another way that you can, yeah.
Sandra, so this is obviously an area of concern, so I'm going to ask you to expand.
It is.
There's a question here: can sole proprietors use PPP program for draw and for independent contractors? It's a complicated question, but you handle that great. So the first question is, you've already answered the first question. You cannot request compensation for the 1099s you issued, but sole
Correct.
proprietors who get 1099s can apply under this program.
Yes.
Is that correct?
That is
Okay.
right. That is right. And there is another caveat, and this peppers throughout the PPP. There is a limitation to how much cost you can include. For any individual that's paid more than $100,000 per year, you can include them in your payroll costs, but you can only include them for up to the $100,000. All of the excess is excluded from your payroll costs. Reason for this is the Paycheck Protection Program. Yeah, it is intended to protect those who earn less than $100,000. Yes.
So I just asked about sole proprietors. How about partners? Can partners include their draw in Payroll Protection Program costs?
That will depend on the corporate organization of the law firm. If you are an Inc., if you're a C Corp, then your partners are all employees. And if your partners are employees and they get W-2s, then up to the $100,000 cap, of course, you may be able to include them. And it is something of an open question, but this is where we've landed on it. It's been a source of discussion. However, if you are a partnership, and when you are a partnership, each of those equity partners is a self-employed individual and pays self-employment taxes. In that case, they are excluded from the definition of payroll costs. So in that case, no. And the theory is the same. Because they can apply individually as self-employed persons under the Paycheck Protection Program, then that's how they have to do it, and the firm can't apply and count them as payroll costs overall. Does that answer the question?
I think that's a great answer.
Cassandra, this is John McSoley. I just wanted to jump in and say I think you're right on that, and I think the way it was done was kind of a glaring maybe error because for instance, a lot of law firms in Vermont are PLLCs. If they decided to be an S corporation, the firm applies for the loan and gets the owner's compensation in the loan base for up to $100,000. If they don't make the S corporation election, you've got a bunch of people who have to do it individually, which seems to me to be a little inefficient.
I can't disagree. And I thank you because I'm really glad that we're doing this together because this was a real conundrum for me and having your expertise. Thank heaven for that.
My pleasure.
So also excluded from those payroll costs are employees that live outside the United States, qualified sick or family leave, wages that are covered under Families First. The theme here is there's no double dipping. So if you're wondering if I can do this and that, the question you ask yourself is, am I double dipping? And there's a lot of places where that comes into play. Was there another question? I heard a voice. Okay. So what can I use these loan proceeds for? This list is a tiny bit longer than what you can use it for that can be forgiven, but not a great deal longer. You can use it to pay the operating costs during the 8 weeks that follow the origination of the loan. The origination, I understand it to be the funding of the loan when the loan is funded. And that makes sense why Dan said they might be holding back on funding because you've got to get yourself set up because you've got to get it spent in those 8 weeks if you want it to be forgiven. What can be covered is your payroll costs. And again, you can only include the first $100,000 of every individual employee. And that, because that falls under the definition portion, that goes throughout until one point that we will talk about. There's one place where it's treated differently. You can include your health care benefits and insurance premiums costs because that's part of your payroll costs. So everything that we talked about in that first list that counts as payroll costs, that is an allowable use. And the exclusions are also excluded here. Mortgage interest, some mortgage interest, rent and lease agreements, and utilities costs. The one thing you can use it for that is not a forgivable expense is you can use it for interest on certain other debt that preceded the loan. And I would direct you to talk to your lender and talk to your accountant about what might qualify. So who is eligible? The eligibility has been greatly expanded when compared to other SBA loans. Any business, most nonprofits, that is only 501c3s, not the other 501s for this program, a veterans organization, which is a 501c19, or a tribal business that has no greater than either 500 employees, and you're counting your full, your part, and other bases in that count, not just your full-time. The size standards that are, you can actually click here to see if you're in a particular industry, whether or not you still qualify as a small business under other criteria. And there are special rules in this act for hospitality and dining industries and for franchises. The entity affiliation rules that usually apply to SBA loans are waived for those particular industries. So if you're in hospitality, if you have a whole bunch of restaurants under one parent, or if you have a bunch of, if you're a franchise under a very large company, you should review those waivers because you may still qualify. So proprietors are also eligible. Independent contractors are eligible to apply. Self-employed individuals are eligible to apply. And you have to have been in operation on February 15th, 2020, and either had employees for whom you paid salaries and payroll taxes, or, and again, this is where the act says, or paid independent contractors. That's what it says, as reported on Form 1099 MISC. I'm sorry, that's what it says in the act, even though they're directing you differently. But you have to have also paid yourself, and you can claim the income you received, as John, I think, said earlier, on a Form 1099 MISC. And so we covered this, so I'll go very quickly. Are law firms eligible? Yes, but just like we described, it depends on your corporate structure, on whether your equity partners are included, but also think of your staff, think of your associates, think of others that are more clearly salaried individuals. The payroll cost is broad. I think we already went through these. Once again, not more than $100,000 per employee per year, pro rata, when you calculate those payroll costs. It does include tipped employees if you've W-2'd them on those tipped wages. And we've already discussed the rest of that. So who's ineligible? Anybody who's, now this is of interest less so to law firms, but any activity that's considered illegal under federal law, and that means you're looking at CBD producers, you're looking at producers that may be producing cannabis legally, like medical cannabis. If they're producing it legally under Vermont law, they're going to be excluded. Gambling, for example, even if it's legal under state law or legal under their jurisdiction, if it's illegal under federal law, they cannot apply for this program. Household employers employing household employees, and I won't linger on this, but I heard a very interesting program on NPR about an activist that was key in bringing together more power for household employees, but they've been excluded under this protection. If an owner of 20% or more of the equity is incarcerated on probation, parole, other criminal law issues, they may not be able to, the business may not be able to apply. So if you want to look at what the exclusions are, you can follow that link. The one thing that you will look at is under that link, nonprofits are excluded, but they are not. So the link, the last I looked, has not been updated to cover that for this particular program, and because it's temporary, they may not. So
okay,
how much
Cassandra,
is this yeah.
Cassandra, before, this is Ted Hobson again. On the ineligibility, I'm a little confused, and I don't know if you can clarify about nonprofits. I've seen both advice earlier in these slides that nonprofits could apply, and I've also seen advice that only 501c3 and 501c19 veterans organizations can apply. Do you know the answer to that?
That part's right.
Just confused.
I do, yes. You just said it. You're absolutely correct. Not only 501c3s and 501c19s can apply for the Paycheck Protection Program. What I was trying to point out here is if you look for the ineligible applicants at this link, you will see nonprofits listed there because normally they are excluded from SBA loans. but for the purposes of the PPP, they are not excluded, they are included. But for the PPP, only if they're 501c3s or if they're veteran organizations, it's limited. If you go back to the EIDL, and I won't confuse you by flipping back, but you'll have access to these slides, you'll find it's broader. For the emergency economic injury disaster loan, more nonprofits are included. But for the PPP, it's limited to 501c3s and those veteran organizations. I think that's what 503c19, right? So for the PPP, it's limited to just those two at present. It could change, but my understanding is that's how it's limited. Dan and John, do you agree with that?
I do. Yes.
Yes.
So how much of the loan can be forgiven? In order to get those proceeds that you've used and expended to forgiven, you have to have spent them in the 8 weeks following the date of the origination of the loan, i.e. the date when the loan is funded. If you do this, expenditures must be thoroughly documented. The Act is clear that although a lot of the requirements are relaxed and broadened, when it comes to the forgiveness portion of this, it has to be strictly documented. Otherwise, you are barred from getting forgiveness. So be very careful to document all those expenses. My understanding is, and Dan can speak to this and John can speak to this, lenders have suggested that you open a special bank account. If you can't, not all of the folks I've spoken to are willing to do that, but you can open a separate bank account just to flow through these expenses. It may help you to document where it all went so that you can be more likely to be able to present everything you need to get forgiveness. As I said, the list of forgiven expenditures is slightly shorter. I think we'll see this on the next slide. It just excludes the interest you've paid on other loans. But the forgiveness is reduced for a reduction of workforce beyond June 30th, 2020, I have a typo there, or reduction in the wages or salaries that are not restored before June 30th, and we will go through those formulas. Your forgivable expenses are the payroll costs, once again, limited to $100,000 per employee. Mortgage interest, but only if the mortgage was originated before February 15th. You can't get a new mortgage and then expect to have the loan expenses forgiven for that. Rent or lease agreements, but the agreements have to have been enforced before February 15th. And utility costs, pretty broad list of utility costs, but the service has to have begun before February 15th. The other element that is not in the Act that came out afterward is that because of this likely high subscription, because the amount is going to go down quickly, they are going to limit what you can pay on non-payroll costs to 25% of the loan. 75% has to be paid, expended on those payroll costs if you want it forgiven. Forgiven amounts will be reduced if you reduced your workforce. The way you figure out that number is you take the number of employees that were employed during the 8-week period following the loan, you divide them by, and that's the average number of full-time equivalents. You divide them by the average number of full-time equivalents of one of these two intervals. It's your choice, either between February 15th, 2019 and June 30th of last year, or January 1 and February 29 of this year. So you can choose which one of those you want to compare your reduction to. You make that division. Or for seasonal employees, you have to use the February 15th to June 30th one. And if you, that's the ratio by which your forgiveness amounts will be reduced. However, if you bring those employees back by June 30th, then you don't have to worry about that formula. If you've reduced your wages, your forgiven amounts may be also reduced. This is where the $100,000 salary is treated differently. If an employee is paid more than $100,000 per year or more pro rata, you exclude them completely from the forgiven amount reduction formula. The reason for this is that they're not seeking to protect employees that make more than $100,000 a year. So where before the amount you could include in your payroll costs, the amount for which you could spend it was just capped at $100,000, when it comes to calculating the reduction for the purposes of forgiveness, they're just completely stripped out of the formula. So you only take employees that make $100,000 or less per year. If your reductions in their salaries or wages per person, you do this on a per head, are reduced by 25% or less compared to the first full quarter of employment before February 15th, you're not reduced. But for every dollar above that 25% reduction, the reductions are applied dollar for dollar. However, if you bring those salaries up by June 30th to pre-February 15th levels, then your forgiveness is not reduced. So you can save the reduction formula by just bringing your employee heads back up by June 30th, and it doesn't have to be the same people as I understand it. It's a head count, or bring your wages back up above that 25% threshold, reduction threshold. If you do both of those by February 30th, then your forgiveness amounts are not reduced. And that's what I explained in this slide.
Can I jump in for a second, Cassandra?
Yes, please.
The full-time equivalent, this reduction is based on full-time equivalents divided by full-time equivalents, and they use 30 hours a week as a full-time equivalent, and that is something that I think started with the Affordable Care Act 10 or 12 years ago. 30 hours rather than 40 hours.
Okay, thank you. So the proceeds from an emergency disaster relief loan that can be financed under the PPP, again, you have to exclude the $10,000. The other, again, we're back to double dipping. If you're going to get both the EIDL and the Paycheck Protection Program, even though they in theory cover the same thing, you can't do that. You can't take a loan, an EIDL, and use it to cover the same injury expenses that are covered by the Paycheck Protection Program if you're also going to take out a Paycheck Protection loan. So if you're going to do both, even if you're not going to refinance, if you're going to do both, you cannot cover the same thing. No double dipping. Okay. Like I said before, if you did get an advance under the EIDL, and if you are refinancing the EIDL under the PPP, which raises your max loan amount, you add that on top of your 2.5 multiplier formula. The $10,000 is stripped out because it was already forgiven, so it doesn't need to be refinanced. So here's the documentation. This is not exhaustive, but this is the documentation required to apply for forgiveness under the Act. You have to be able to verify your FTEs on payroll during the period and their pay rates. You have to demonstrate your payroll tax filings reported to the IRS, your state income payroll and unemployment insurance filings, documentation verifying the eligible costs covered by the loans, and documenting that you actually made those payments. And you have to give a certification from a business representative that the documentation is true and correct, the forgiveness amounts requested were used to retain employees, and make other eligible payments, and any other documentation that the administrator deems necessary. So there is some wiggle room in there. You also have to do some certification when you apply for these loans. So there's a risk of fraud if you are taking these loans out for other purposes other than COVID-19 relief. So just be aware of that liability when you're applying for one of these loans. Documentation for the forgiveness is absolutely mandatory. It's under the Act. So if you're relying on that forgiveness, and I would again remind you, this is a loan, don't rely on it. But if you are hoping to have it, then be very mindful of your documentation. When you've applied for the forgiveness, the lender is required to issue a decision within 60 days, and the forgiveness amounts are excluded from your gross income for federal tax purposes. If there are amounts that are not forgiven, they are to be repaid over a 2-year period at 1%, and payments can be deferred for 6 months, which may be extended, but make sure you request that from your lender. So this loan is not done directly to the SBA. You must go to your lender. It can be an SBA lender. The list of approved lenders is being expanded as quickly as possible. A federally insured bank, a federally insured credit union. We recommend that you go to the lender that you already have a relationship with, but you don't have to. you make your choices. The loan program started last Friday, April 3rd, for small business and sole proprietorships. And for independent contractors and the self-employed, it will begin on April 10th. Applications are available through your lender, but you can also get a copy online, fill it out, and take it to your lender. So these are the certifications that you must make to get your loan. You have to certify that your business was in operation on February 15th, that the current economic uncertainty makes this loan request necessary to support your business's ongoing, sorry, I got a request, ongoing operations. The funds that will be used to retain your worker, the funds that you get will be used to retain workers and maintain payroll or make those approved expenses like mortgage, lease, utility payments. And you have to certify that you understand you're liable for fraud if the funds are used for other purposes. So just the fact that it's so much easier to get these loans opens it up for fraud, and we are expecting maybe not immediately, but ultimately some pretty close tracking of these loans, and so don't be loosey-goosey. You also have to demonstrate that the business, yes.
Quick question, a quick comment from, this is Scott McGee speaking. The form itself, the application form, has preset categories, and all the certifications are all in there. You just have to initial them. So a lot of this stuff, right, when you see the application form, it's very simple, and you can go through it pretty quickly, and this stuff will take care of itself.
That part is true. Just make sure you read it before you click it.
Right.
Okay. Lenders can rely on the borrower's representation, so they have some cover there. And self-employed and independent contractors and sole proprietors will also have to submit some additional documentation because they have to demonstrate what their income is, the payroll costs are that they're covering. So, very quickly, eligibility is broad, barriers to access are low, the money is going to run out, so don't delay. And there is an appeals process, but you don't have to worry about that just now. Here are some links. You can take a photograph of it now, take it off the slides when you get a copy later, but this should help you to get information that you need and to get access to applications. Even when some of these are, I will point this out, particularly the U.S. Treasury fact sheet, if you download this PDF and you want to rely on it a few days later, please download it again. I've seen it change. So although it appears to be exactly the same thing, even though it's a PDF, I've downloaded it one day and then downloaded it a different day and found out that the content was different. So just be aware that everything changes. So refresh anything that you're relying upon. So I've now moved out of the loan program, and there are other forms of relief available in the CARES Act. This is not necessarily an area, this is an area that either Ted is going to speak to or Dan or John. I'm not going to linger on these slides because we are running low on time, but I want you just to be aware that they're out there. So you can look at these when you get a copy of the slides. There are loan payment subsidies available under the Act. There are tax credits that may be available. You cannot do, one thing I will tell you, you cannot do the Employee Retention Tax Credit and the PPP at the same time. That's probably something that either John or Dan can speak to. Can you maybe explain how the Employee Retention Tax Credit works?
It's a credit against payroll taxes on your 941, and it's I think it's 50% of wages up to a maximum of $10,000 per employee. So to the extent that you pay people and haven't taken the PPP loan, you just stop paying payroll taxes until you've made up to either what you paid them or $10,000. And there's of course, there's a new form for it that's out in draft, Form 7200, and I think they'll have to revise the payroll tax forms, the 941, to reflect this too.
And will the extension of the tax filing deadline extend that relief as well?
No, I don't think so. No, I don't think all of these would all be within the payroll tax system, and I haven't heard of any, although the payments are going to be reduced I haven't heard of any filing deadlines being changed yet.
For payroll taxes, okay. So there's also assistance to individuals that will also help sole proprietors because they're also citizens individuals if they're not earning over a certain amount. It may also help to alleviate some pressure on your workforce because the payments to taxpayers is not based on, in this case, not based on unemployment. But also the unemployment insurance programs have been expanded. And this is where we hit a conundrum that I want to flag. So if you get a PPP, you've got to spend this money on at least 75% of it on your workforce, 25% of it on other things during those 8 weeks. But we also have this expansion of the unemployment insurance programs under the CARES Act that adds for a period of time until July another $600 per week on top of the unemployment insurance benefits that they're receiving. So it makes it, a significant sum of money, and we may run into a situation where employees will say, whether it's employees of the law firm or employees of your clients, I'd rather sit at home and collect unemployment for this period of time. Not everybody's going to say that, but that is a conundrum because if, for example, to weather the storm, you send employees home to collect unemployment insurance, or as it has been said by the Vermont Department of Labor, I think it was Department of Labor or Senator Bernie Sanders' office, you can actually set them to part-time and they can still collect unemployment insurance when they're part-time. And even though their unemployment insurance payments from the state will be reduced accordingly, they still get the full $600 per week, even if they've got part-time employment. So that may be a strategy. However, you still have to spend that money. And this is a conundrum I don't have an answer for because if you've reduced your expenses in order to survive, you may not be spending the full amount that you're relying on to be in that 8-week period to be able to have it forgiven. So it's just, you have to plan this out very carefully to make this work for you. There are also changes to the IRA contribution plan contributions that are intended to help individuals. You can borrow from your 401k, or 403b without penalties. And you can spread that reported income. Another thing you can do for your employees, yeah, I did. There's one thing I do want to point out for your employees. The one thing that you can do to help particularly your associates, is that employers can make payments on student loans for up to $5,250 between these dates, March 27th and May 31st, and it can be excluded from the employee's gross income. So that's one thing that employers can do to help perhaps alleviate some of the pressure on their employees who still have student loans left. And then for the individuals, also their student loan payment interest accrual is suspended until September 30th, and that may be extended.
Okay,
unemployment benefits. This is for you, Ted.
Yeah, this is for me. This is called H742. It's actually an act that just doesn't have a number. It was signed, I believe, last week. And there is a seminar for self-employed individuals by the Department of Labor at 2 o'clock, and I'll put that link up. This act changes unemployment benefits radically. An individual is not who's voluntarily separated from employment is not disqualified if the person is self-isolating, is recommended by a healthcare provider, or because the government has told the person to self-isolate because diagnosed with COVID-19 coronavirus, has symptoms, exposed, or belongs to a class identified as high risk, for instance, senior citizens. Next slide, please. Or if there's an unreasonable risk at the workplace. An unreasonable risk means the employer is not following state government guidelines as to, or federal guidelines, as to reducing the risk of employment. So if they're not following guidelines, then the employee is entitled to leave employment, and that's not considered a voluntary quit. Next. Also, the employer is not charged if an employee voluntarily quits to care for a family member who is self-isolating as advised required by the healthcare provider or the government, if the family member is diagnosed or experiencing similar symptoms or is exposed to coronavirus. or to care for a child under 18 years of age because the child's school or child care has been closed or unavailable, or for 8 weeks if the employer ceased operation either partly or completely in response to a government directive. So these are very broad exclusions from the voluntary quit rule. Or for 8 weeks, the employer ceased operation either partially or completely in response to the government directive if the employer rehires the individual in a reasonable time after the employer resumes operation. So now we're going to go to Section 31 of the Act, which is the employee disqualification. And so we've just been talking about employers and what is not chargeable, and now we're talking about employees and how they're not disqualified. So if the employee left, even though the employee left, quote, voluntarily of their own initiative, they left employment to self-isolate at the recommendation of a healthcare provider or a government directive because diagnosed and experiencing symptoms, or was exposed, or in a high-risk group, or because of an unreasonable risk of exposure as the place of employment, which I mentioned earlier, or to care for or assist a family member who is self-isolating pursuant to directive because diagnosed, exposed, or at high risk, or to care for a child under 18 whose school or child care is closed due to the pandemic, which is a lot of people in Vermont. And as Cassandra mentioned, this is a very strange situation. Bernie Sanders mentioned on the floor of the Senate, but if a person is getting partial unemployment, and this is from the Department of Labor, and I put up the transcript link, they are entitled to get that partial unemployment plus the additional $600 for part-time employees that the federal government has granted. So maybe they're getting $200 in benefits, they get $600 on top because of that supplemental benefit. And I'll put the link up when I get done here.
Well, we've covered most of this. This was the employee retention tax credits that John spoke to. I've thought there might be a payroll tax postponement. Deferred amounts were payable over 2 years. We may have to check on that. There are other changes: treatment of losses, corporate AMT credits, limitations on business interest expense. There's also an excise tax exemption for hand sanitizer. Is there anything there, John, that you think should be pointed out?
You know, one thing is the treatment of losses. Two things. In the 2017 Act capped business losses at $250,000 or $500,000. That's gone temporarily. And then net operating losses used to be under that same 2017 Tax Act were deductible to the extent of 80% of income. Now it's 100% of income, and they can be carried back for 2018, 19, and 20 losses can be carried back 5 years. So if people have clients who have cash flow issues and losses, they can free up some tax refunds by filing carryback loss claims.
There are changes to the paid sick leave and family leave provisions under the Families First Act. This is an area that I'm not going to dig into, but I just gave you in this slide, the bare details. There is more information that you can find. There's a really nice, short, direct, concise client bulletin on Gravel Shea's website that was written by my colleague, Heather Hammond, and that might help point you in the right direction. But there's also some really good resources at the IRS website that gives you the tax credit part of it, and on the DOL, the U.S. Department of Labor website as well, gives you a good view from the labor side of it. So these links can help you get your hands around the Families First Act. And this, I don't need to spend any time. This was just to give you an idea of what the CARES Act covers. There were also economic stabilization initiatives in the Act that covered certain industries and also covered mid-sized business loans. That's for companies that don't qualify for the small business loans. And so these are the requirements for that, which is really for discussion on another day. There are other relief like a foreclosure moratorium, a right to forbearance, eviction protection, credit reporting relief. These are other forms of relief that are provided for under the Act. In our slides, we have, actually this is Ted. The blue slides are Ted.
Sure. So I just put these links up. These are some resources available. There are excellent resources available right now. There's are starting in 20 minutes for the Department of Labor for self-employed individuals. If you're self-employed, I would highly recommend it. These have been super webinars put on by the. I've just put the link, I believe, up, and I put it up just a few moments ago. So I highly suggest that you use these resources. People are working very hard in state government and federal government and banks and accountants and law firms to get everybody the information they need to make decisions. But anybody who's a sole proprietor should probably listen to or be on that webinar at 2 o'clock. I can send a link out later. They put them on YouTube if you're not able to get to that one, but they've been excellent. Go ahead, Cassandra. And that's the Brattleboro Credit Corporation's having webinars every Friday. They've been excellent. They've included the congressional delegation. They've included the SBA, the Department of Labor, and I've put up the links, and there's a transcript, the YouTube link, and there's a transcript that I had on Otter AI where you can follow it. Final slide. Next is final slide. This is our contact information. So yeah, that's it.
Your early flight doesn't want to come.
Okay.
So yeah, these are contact details. Should you have additional questions for each of us?
No longer talking about financial relief, talking about personal relief. The Metropolitan Opera is offering free streaming on its website every day, all day long. I just watched AIDA last night. It's a great source of relief, and I encourage everyone to use it. So I think people are probably happy to stay on and take any more questions. There we go.
There we go.
And
it's not in a slideshow, but that's okay.
That's AIDA. It is fantastic, and anybody who likes opera, I highly recommend. So do we have time for some more questions, or?
I would recommend that people ask questions of Dan and John, since I did a lot of talking, and they may have, we're really lucky to have them on board. So if there are specific questions to Dan as a lender or John as an accountant, I think that would be, if we can focus on those, I think that would be valuable. But I'm happy to answer questions too. I just want to make sure.
Okay, so
good use.
I'll ask one. What should be submitted with a PPP application? What are for instance, I've heard give copy of both sides of driver's license, articles of incorporation, in addition to the payroll information. So Danielle or John, can you answer that question, please?
John,
Dan.
You want to take it?
By all means, go ahead.
All right, thanks. So the application, of course, signed appropriately, your 941s, your W-2s, W-3s, your 19 tax returns, if they're available, or your personal or your profit and loss statement, as well as any other documentation related to the expenses that qualify, the contributions made to your retirement plans, the state taxes that you pay, anything along those lines. In terms of your driver's license, no, we have not been requesting or requiring the driver's licenses. We are requesting that our clients submit documentation that show that their business is in good standing. If they can get their hands on that, that's great. That's the general extent of it, and we're processing that. We're taking that in. Using those key pieces of information for determining the appropriate amount.
Okay, I'm going to ask a tough question, but I know there's not an answer to it. Am I better laying off my employees so they can get the $600 per week subsidy?
That's going to be a per case basis. Are you asking me?
I'm just throwing it out because there really is no answer to it. But how would one consider what the options are there?
Well,
can I jump in for a second?
Yeah, please. I would love it. Yeah.
Oh, go ahead. Part of it depends on what people think the recovery is going to look like after, more than 8 weeks out. Because if things are back to normal and they're going to be able to keep their whole pre-COVID payroll busy post-COVID, then I think then I think it makes sense to go with the Payroll Protection Program and just have 2 months paid, or 2 months paid by the government, and then everyone is happy and back to work. But if it doesn't look like that, you know, they may get to the end of 8 weeks and have a payroll that they can't support.
Okay. Well, thank you very much, everybody. I think this has been a wonderful presentation. Most of the attendees have had to move on to other things. So I appreciate Scott McGee really was the impetus for getting this going. Cassandra, you have been absolutely wonderful. We very much appreciate the individuals, Daniel and John as well. And stay tuned. There'll be more information. Thanks so much, folks.